To shed more light on this, joining us on the show is Gautam Duggad. He's head of research at Motilal Oswal Securities. Good morning, Gautam. Good to have you on the show. I was going through your report, and you've clearly stated that we've actually completed a cycle in these 2 years. But let's start with valuations. You say that valuations at this point are rich. And going ahead, you see some kind of risks emerging on the horizon if earnings do not keep pace with expectations, so the current valuations would not be able to be justified. Let's start with how comfortable or not are you with the current price to earnings multiple?
Sure. Good morning. So as we have mentioned in that report, we basically traced the journey of Nifty from 9,000 back to 9,000. And a couple of things which have changed in this circular journey between the 2 years. The first fact remains that valuations are not comfortable because what has happened in the last 2 years, essentially the earnings backdrop of a lot of sectors has changed. Today, as we speak, we are staring at a 23 times, almost 23 times trailing PE and somewhere closer to 18.2 or 18.3 times forward earnings, forward PE. And this is basically predicated on a 20% earnings forecast. If for some reason this 20% earnings growth were to come down to 10%, which has historically been the case for the last 4 years, and if that happens, then you're looking at a forward PE of 20 times. Now, with that kind of entry valuations on the PE basis, if you go back in the past, there are not many incidents where you made too much of money entering the markets at 20 times forward PE earnings. That is point number one. Point number two is that while we are predicting a 20-21% earnings growth for our broader universe as well as for Nifty and Sensex, we are fully cognizant of the fact that midway into the year we are going to look at GST. GST as of now, as things stand, is going to get implemented from 1st of July. My sense is that it may induce some earnings volatility for a quarter or two as the trade channels adjust their inventory ahead of the implementation, and there could obviously be some implementation related hurdles which will come through once the GST is launched. So to that extent, the earnings, while the predictions are quite good, there is some sort of an uncertainty which we are staring at. That being said, another headwind or rather uncertainty which has emerged is rupee. Now rupee has appreciated 5% almost in the last 3-4 months. I was just looking at some of the data points over the last 25-27 years. Only in only in the past 4 instances we have seen rupee appreciating by more quantum in a period of 3 months. So this is quite significant and has several implications for the earnings universe of export-oriented sectors like IT, pharma, and some of the auto and oil and gas names. So while the markets are buoyant, flows are very strong, one has to remain fully cognizant of the fundamentals and obviously the earnings drivers, which while the expectations are quite high, the recent track record as well as some of the uncertainties which are lurking in the horizon, one has to be very cautious around those levels.
Right. You also mentioned that you expect a 21% CAGR in terms of earnings growth aided by a low base in the second half of FY17. In the risks, you've already highlighted there's GST, there's also the rupee strengthening, which obviously hurts certain sectors, but there's also inflation and commodity prices. I mean, we've seen the kind of WPI number that we've had for February. We'll be getting it in this month by around the 12th as well, 6.5%, and that clearly the divergence between the retail and the wholesale end has completely reversed and overcompensated for itself, in fact. So, you've mentioned consumer sectors. We've seen auto companies starting to take hikes, but for wire manufacturers, white goods manufacturers, auto companies, paint companies, do you think the elbow room or pricing power exists for passage?
See, what has changed in the last 2.5 years is that we had gotten accustomed to margin expansion quarter after quarter. And that was obviously predicated on a very benign commodity cost backdrop that we had. So in fact, as we sit here, we are looking at this quarter where the margins will contract for first time after 8 consecutive quarters of expansion as far as operating margins for our universe, excluding financials and OMCs are concerned. So clearly the commodity cost equation has changed. That is point number one. Point number two, you alluded to the pricing power. Now, pricing power has to be looked at in the context of where we are in the demand cycle. Now, third quarter FY17, we have seen demand deceleration for a lot of consumer-oriented sectors, be it FMCG, be it auto, be it cement. So, this sector's demand got moderated in the third quarter, and as we as we assess fourth quarter, we will obviously come to know how far that has spilled over into the fourth quarter. But my sense is that some of the consumer-oriented sectors would still have seen the spillover effect of demonetization even in fourth quarter. While situation is considerably improved over the last 3 months, we have seen a lot of remonetization and trade coming back to normalcy. But the fact remains that this started happening towards the lower part of February. Now, as we step into FY18, clearly the expectations are that margins are going to contract not by much magnitude, but around 20-30 basis point. What is crucial, however, from a margins point of view, apart from the commodity, commodity pricing factor that you mentioned, is how soon we see demand recovery happening at the top line level. Because if that were to happen, then that can take care of a lot of this commodity price inflation, because that provides a very strong operating leverage to the whole P&L, and that basically can offset some part of the commodity cost inflation impact that we are discussing. So that still remains to be seen, and one would get more clarity around it as we step into first half of FY18. But as things stand, for the time being, for this quarter, we will see margin contraction for our broader universe after 8 quarters of consecutive expansion.
Right. Gautam, for the last 3 years, the earnings haven't matched up to what was anticipated at the start of the year. What makes you optimistic, if at all, that we will hold on to this 21% CAGR at the outset?
Now, obviously, it's like, last 4 years, we have seen earnings staying flattish. The Nifty EPS has been hovering around 400, 410 mark for last 3 years, from FY14 to almost FY17. What changes for FY18 are a couple of things. One is obviously the low base, which obviously was there even for FY16, FY17. But what has impacted FY16 was the asset quality review that we had seen, which came into the second half of FY16, which impacted the earnings to a fair bit. FY17, starting in April, nobody would have predicted demonetization. So FY16-17 also has a backdrop of some unprecedented events which have happened. FY18, as I highlighted earlier, while the expectations are for 20% earnings growth, we have 2 or 3 risks lurking in the horizon. One is currency, the other is GST, and third, of course, is monsoon. As we come to June, July, we all look at the skies. Now, what gives me some bit of confidence compared to FY17 is we have seen inflation, as we were discussing a couple of minutes back. Now, inflation also adds to the pricing power of a lot of consumer-oriented sectors. Commodity earnings are reviving. PSU banks have a very depressed base as we speak. Fourth quarter, obviously, last year they had a loss of 15,000 crores. This quarter, we are expecting a profit of 3,000 crores. So FY16, FY17 basis will itself provide some sort of a cushion for FY18 earnings. Now, one can debate whether it is 20% earnings which will happen on 15-16. But I'm fairly confident that FY18 will see a double-digit earnings growth. If not for any significant improvement in operating dynamics, then at least for the base effect. And then there are a couple of sectors where clearly things are improving, be it on the consumer side, where you will see, as we step more and more into FY18, the effects of demonetization completely waning. Secondly, auto, we will see improvement in auto numbers also as we move forward. And 7th pay commission, which has happened last year, all of this put together should provide some sort of a delta to discretionary consumption. One of the points which you mentioned in your opening remarks is about our expectations of how GST and demonetization can be a very strong earnings driver from a medium-term structural point of view. So there are several stocks, several sectors where the benefits will accrue given the very tectonic shifts which are happening on the policy side. So, the unorganized to organized, a well-debated theme, and it encompasses several sectors. So there will be several stocks, several companies, subsectors, which will benefit from this larger mega trends which are underway in the economy.
Let's speak about specific sectors then. You expect a recovery coming through as far as metals goes, PSU banks and oil and gas. Now, my question is that at the start of the year, no one could have fathomed that metals will be, Hindalco will be the top gainer or a Vedanta will be the top gainer. So does the outlook remain bullish even from these levels in terms of fundamental earnings growth? Because we've anyway seen quite a lot of it through the last year. So sustainability of the same. That PSU banks have started to see stock-wise some bit of an improvement over the last fortnight odd, and even oil and gas from the refineries standpoint.
So all the sectors that you mentioned are commodities, and of course PSU banks has its own unique set of challenges. Now, as far as commodities are concerned, we have all seen how they have performed in the last 12-15 months. Both earnings as well as stock prices. Commodity prices have gone up, whether it is LME or whether it is energy prices. Now, the unique challenge when you invest in commodity-oriented stocks is typically you don't buy stocks when commodity prices are ruling very high. One has to be a little more contra on that side of the equation, where you end up buying stocks when the commodity prices are looking bad and the near-term outlook doesn't inspire much confidence. Today, the situation is very different. The situation was prevailing in FY16 and somewhere around Jan to March 16, when commodity prices were not, buoyant and earnings were depressed, and valuations obviously were in your favor at that point of time. In the last 15-16 months, all of that has changed. Commodity prices have improved, earnings have improved, and stock prices have doubled, or in fact more than doubled in some of the cases. So therefore, entry valuations in this particular sector, do not provide too much of leeway for margin of error. As far as PSU banks are concerned, that's a very volatile situation out there. It's more news-driven and trading-oriented sector it has become in the last 2 years. Today, as we speak, there is expectation of some sort of measures or some sort of initiatives coming from the government or central bank side as far as the resolution of stress asset is concerned. Till one sees clarity on that side, fundamentally taking a structural view on this bunch of PSU banks is always fraught with risk. So, as far as we are concerned, we favor private sector banks. Within private sector banks also, we favor retail-oriented private sector banks and mid-sized private sector banks. That is where our preferences lie. As far as oil and gas is concerned, we've been very positive on the downstream OMCs for the last 15-18 months. Even there, we have seen very strong stock price performance. What is different for OMCs today is that valuations are still not prohibitively expensive for the top 3 OMCs. Within that, we prefer Indian Oil Corporation, where the valuations are a little more benign compared to BPCL and HPCL. As far as upstream is concerned, we have seen very strong rally in Reliance so far. ONGC, again, there is a low base which should help them in FY18. But our preferences, as far as oil and gas sector is concerned, is more towards OMCs, and within OMCs, more towards IOC. So that is as far as those 3 commodity-oriented sectors are concerned.
Right. You've also dedicated a significant portion of your report to under ownership or over ownership by FIIs. If you speak about fund flows, we've seen that obviously DIIs have continued to support through this 2-year period. Now we've seen FII and FPI inflow come in a big way since the end of January. So February, March have been buoyant months. Speak to us a little about how under-owned FPIs and FIIs were in certain of these heavier weighted stocks where they have increased exposure to some of the private banks in that list. Reliance Industries is, of course, one of the major ones, which has been a beneficiary of that under-ownership. And you also mentioned stocks like ISR, Adani and BPCL.
So if you look at the flows over the last 24 months, we've seen very unique trends which are emerging. DII flows have taken the dominant portion of the total institutional flows in the last 24 months. We have seen DII flows totaling around $16 billion from March 15 to March 17. And FII flows somewhere around 6.6, 6.7 if you do the same maths for the last 2 years. And bulk of those flows came in the month of March 17. We have seen almost $4.8, $4.7 billion of FII flows coming through just in 1 month of March. Now, what has happened as a consequence, because the DII flows were more dominant, is that the mid-cap part of the market has seen significant valuation expansion. Now, if you look at it in terms of numbers, the valuation premium for mid-caps has expanded from around 10-11% to 3 months back to almost 20% now. Now, DI flows typically, one has noticed that DI money goes more into bottoms up, mid cap ideas. So that has happened. The mid cap valuation has expanded significantly. Now, as we speak, in the last 2 months, more so after the UP elections, we have seen that FI flows have come back into the market with a big bang, and clearly that is also reflected in the way the large caps have performed. As far as sectors are concerned, from the fund flow perspective, we have seen that foreign flows have typically gone into more high quality B2C oriented names, more towards the large cap side, and which is what the report also points out. Companies like ISR, we've seen significant increase in ownership. Now, what has happened from a DI point of view is that a lot of DI funds were underweight on Reliance, and this rally has obviously caught a lot of people by surprise. So you're seeing some rebalancing happening on some of the large caps from the DI flows point of view. Somebody who was underweight, some of those funds have corrected their under ownership, and that is what we have seen, a 30-35% kind of rally in a matter of 2 months in one of the largest stocks within the universe. But the fact remains that as long as DI flows dominate the overall part of the institutional flow equation, you will see mid caps continuing to do well. While the precedence of large cap versus mid caps suggests that the premium to large caps has not lasted for far too long, clearly at the moment this is driven more by liquidity than by earnings flow, than by earnings performance.
Right. Gautam, and if you can also take us through the derating and the re-rating picture. Of course, the defensives, IT and pharmaceuticals have been the worst sufferers because of the regulatory overhang and sluggish earnings, US FDA observations, and even what we've heard from Donald Trump. But in terms of the re-rating prospects, are there any sectors that you're looking at that have those prospects, or will re-rating prospects be limited to stock-specific action? A, that, and B, if you can take us through some of your top preferred bets from the large as well as the mid-cap universe.
Sure. So as far as valuations are concerned, clearly the room for further re-rating is very limited, and that's the point we've tried to highlight in that note, that if the upside were to sustain, the earnings has to come from now onwards, because we've already seen the PE re-rating which has happened. Now, as far as the sectors are concerned, we have seen continuous de-rating of pharma, IT, and for that matter, if you will, even consumer, because the last 2 years, a lot of consumer stocks have time corrected. They've not fallen significantly, but clearly by virtue of being where they are, and meanwhile in the last 2 years, earnings would have grown by 15-20%. So time correction has happened for a lot of consumer stocks. So these are the three sectors where we have seen continuous de-rating. And re-rating, the names are quite obvious. Some of the select auto names, some of the consumer discretionary, some of the private sector banks, the part of the market where the earnings growth has been good, that has attracted more and more money, and consequently that has resulted in a significant valuation re-rating. Going forward, we think that the room for valuation re-rating as far as PE multiple or price to book multiple is concerned for various sectors, it's very limited. One has to rely on earnings growth for those valuations to sustain. Otherwise, we think there is a possibility of valuation de-rating for a lot of this, overheated names. As far as top ideas are concerned, we've not had too much of a change in the pecking order. Within the large cap, we continue to like Tata Motors, we like ITC, we like some of this private corporate sector banks, maybe one or two, ICICI Bank and SBI. We continue to like HDFC Bank, RBL, Titan. As far as mid caps are concerned, we like Britannia, we like JK Cements. So the orientation clearly is to find ideas where the earnings visibility is high, where the structural story is strong. Even if one do not make money from the next 6 to 12 months point of view, one still has some catalyst because of the demonetization, the GST, the whole value migration which is happening from unorganized to the organized side. That is where we are trying to put our efforts on as far as finding ideas are concerned, if not for 1 year, at least for 2 to 3 year point of view. And those are some of the ideas that we have highlighted, where the view remains constructive from 3 to 5 years perspective, because a lot of these changes which are happening today, while in the near term they sound while in the near term they do not excite too much, but from a longer term perspective, these reforms, these policy changes are going to create a lot of winners in the Indian markets across sectors. And that is why I alluded to the term value migration, where unorganized to organized, public sector banks to private sector banks, a lot of those areas will see emergence of new winners.
Fair point, Gautam. We're going to leave it at that, but thank you so much for taking us through a detailed dissection of what your report suggests and what the sectors that you're positive on going ahead from here on, as also your earnings expectations from here. Let's continue with the focus on earnings, and we'll focus on IT earnings now. Infosys is due to post its Q4 earnings later this week. The